Good evening, everybody. We'll go ahead and get started in about 1 minute here. Going to start on time. Could just like to ask if someone could give me a yes if you can hear me clearly over the if my voice is coming through clearly. Thanks, Joe. Okay, excellent. Just double checking the recording. Looks like we are ready to go. Give me one split second and we'll get started. One moment, please. Okay, everybody, welcome to tonight's free Tuesday night webinar. My name is Dave Aquino, and I am the specialist in charge of the stocks and options live trading room. Just want to welcome you this evening. I know it's a Tuesday evening, and want to show you this material because I think it's very valuable to individual stock traders and options traders. If you are not already in my room, hopefully this will give you some insight into some of the trading techniques that we use, and hopefully that would encourage you to come and visit the room and give our subscription a try. Okay, the title for tonight's webinar is Daily Profits with Options and MQ Momentum Divergences. It's a technique that we use every single trading day in the live trading room, and hopefully by the time we finish this presentation you'll see why. Okay, if you have any questions as we go, please feel free to go ahead and submit them via the GoToWebinar side questions menu. I'll try to pick up the questions as they come in. I'll try to answer them in a timely manner, especially if we're talking about the same material at that same time. If not, I'll catch it at the end. Usually pretty good about answering questions quite quickly. Thanks, Ron. Risk disclaimer. Now, we at Microquant want you to know that trading or investing carries a high level of risk and is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. Now, this content is subject to change without any notice. It is provided for the sole purpose of education and assistance in making independent investment decisions. Value Charts has been taken reasonable measures to ensure the accuracy of the information contained herein. However, Value Charts does not guarantee its accuracy and is not liable for any loss or damage which may result directly or indirectly from such content or from an inability to access such information or any delay in or failure of the transmission or the receipt of any instruction or notification in connection herewith. Any past performance results are shown for illustration and example only, are hypothetical, and as such have many inherent limitations. Now, no representation is being made that any account will or is likely to achieve profits and losses similar to those shown. Now, most importantly, past performance is not necessarily indicative of future results. Sorry, 1 second here. Okay. And next is CFTC Rule 4.41. Now, this is a U.S. government required disclaimer, and basically wants you to know that futures trading in futures and options has large potential rewards, but also carries large potential risk. You should be aware of the risk and be willing to accept them in order to invest in the futures and options market. Do not trade with money you cannot afford to lose. This is neither a solicitation nor an offer to buy, sell futures, stocks, or options on the same. No representation is being made that any account will or is likely to achieve profits or losses similar to those discussed on this website. Now, past performance of any trading system or methodology is not necessarily indicative of future results. If you have any questions on either of these two disclaimers, feel free to send us an email at support@microquant.com and we'll try to help you. All right. Again, the topic of tonight's webinar is daily profits with options and MQ momentum divergences. Again, if you are in my live trading room, you guys know this stuff pretty well. You see it every day, but I'm more than happy to go through it for anybody that hasn't seen it before, because it's an excellent way to make money. Okay, so the first question that comes up is these divergences normally appear at the opening of the market. At the open, 9:30 Eastern time, and proceed for the next hour and a half, as sometimes even 2 hours. It just depends on the day. So why do we trade the opening of the market? We have a saying on Wall Street, it says amateurs open the markets, professionals close them. The long and the short of it is, the reason why we trade the opening of the markets is there are lots of opportunities to take advantage of individual retail investors that don't know any better. If you take a look at a normal daily bar chart, usually the open and the close are at the opposite ends of the bar. I'd say roughly 2/3 of the time the setup is like that. For our purposes, trading divergences with options, the opening hour provides a period of increased volatility and order flow. The imbalances in the overnight orders create opening gaps and then also movement in the stock price. The opening range is usually has a tradable price action. Now, when I say opening range, usually that's price action that fall between a high and a low of the first hour. Sometimes it's the first 30 minutes, but usually it's the first hour. And that opening range usually has tradable price action and then could lead to possible breakouts, either up or down. Okay, price action in the first hour in the right stocks. This is important. Can't just pick any old stocks, but the right stocks can historically, basically the 10 months that I've been trading these, actually it's almost 11 months now, I normally get anywhere from 4 to 6 very nice momentum divergences that we can trade with options. Okay, options provide the leverage to magnify our daily profits. We trade these intraday, so we're in the morning and we're out in the morning. There's no overnight risk to these trades, because if you've been trading stocks long enough, you hold something overnight, you may be in a position where an analyst comes by or a news event occurs that actually pushes your stock either higher or lower. That's great if it goes your way, not so good if it goes against you, especially if the setup is a very nice setup and then we get an interjection of some sort of external event that really blows up your setup out of the water, and all you can do is just take the loss. Now, these momentum divergences, especially when we trade them against daily support and resistance levels, okay, provides, and this is important, why we trade them. They are very high probability winning trades. Okay, they're very high probability. It's not only do we get 4 to 6 opportunities every day, but they are very high probability, and if you trade them well, there's a very good chance that these trades will earn money. Okay, again, this is the morning. You want to be this guy. You want to be this guy. You do not want to be these retail traders. Okay, so we try to take advantage of the fish that school in the opening hour, and when we take these divergence trades, really good chance of getting some fish every single day. Elizabeth, one of our traders, calls them her grocery trades, because you step into the market every morning, you make some money, and you have grocery money for that day. You don't have to worry about not having enough money to eat. Thomas usually refers to these types of trades and the way we trade as a golden shovel. You go into the market every day with your golden shovel, you dig out some profits, and you go home for the day. It's a nice way to trade. For those of you that are a little bit new to value charts, I want to first touch on the 3 components of technical analysis so you'll understand how we're reading our charts. Okay, first is price, and those are still our traditional open, high, low bar charts that you see on every single chart. Then we have momentum. Maybe you've seen MACD histogram bars before. That shows the price momentum and when we have inflections in momentum. That's also important. And the third component of technical analysis, value. If you're not familiar with value charts, you probably don't understand what value is. Most of the time, most financial people, or a little bit people with some experience in the financial markets, when they say value, they're thinking about a value mutual fund. The difference is when we talk about value, we're talking about an objective evaluation of what the current price is versus the previous past price history. In that way, we are comparing in an objective way where price is now compared to where it's been, and that gives us a good idea of what the current value is. A very good example. I'll try to talk a little bit louder, Ron. Can everybody hear me okay? I might be coming through a little bit quieter. Give me 1 second here. Okay. Add a little fan there. Okay, good. So again, that is our idea of value. A good example of it is if you know that the current value of your new Toyota Camry that you want to buy, it's $20,000. Okay? And then someone comes in and says, hey, I have this Camry I can sell you. It's exactly what you want, and I'll sell it to you for $22,000. You'd look at that and you'd say, wow, I know it's worth $20,000, but it's selling for $22,000. I don't want to buy here. You don't want to buy here. Someone comes along and says, hey, look, I have a Camry. It's exactly meets your specifications. It's the selling price right now is $17,000. You're going, all right, that's exactly what I want to buy. I want to buy when it's undervalued, not when it's overvalued. Likewise, if you're trying to sell a car and you know that used car that you're trying to get rid of is worth $10,000, if someone says, hey, look, I'll buy it from you for $12,000, you'll be like, yeah, I know it's $10,000, but he's willing to pay $12,000. I'll do it at $12,000. I won't sell it for someone said lowballs you and say, hey, how about $6,000? You're like, no, I know it's worth $10,000. I'm not going to sell it at $6,000. So you want to sell when it's overvalued. Okay? So you have to understand the concept of value and how it applies to stocks. Usually it's the opposite. Most people want to buy when it's expensive and sell when it's cheap. I don't understand it, but when we're trading, it really makes a difference. Okay? All right, so again, the 3 components of technical analysis: open, high, low, closed bar charts. That's what we're going to look at price with. Value, we're going to look with the value charts and by extension our value bars system. I primarily use value bars. And for momentum, we're going to use this MQ momentum indicator. Very simple. And I also use this Trade Station squeeze indicator. I know Trade the Markets also has a version of it. This is a simple one that we use in the live trading room. Okay, here's the settings for anybody that currently use value charts and value bars. I use a 5-bar analysis period for value charts and value bars. MQ regression, I'm not going to really talk about that, but I'll use the 100-bar setting. And then MQ momentum is the standard, and the squeeze, I believe this is the 2 standard settings. Now, when I trade intraday, I use tick charts. You can use 1 to 2 minute charts. Those are okay also. But I actually prefer tick charts because it captures a lot of the opening period momentum very well. The 1 to 2 minute bar charts may not as thoroughly. So I use tick charts. Okay, all right. So again, value charts and value bars. Touch base one more time. Here's a better representation of what I'm talking about. Remember, fair value is the green middle section. We have moderately overvalued in the yellow and the moderately undervalued in the also in the yellow below the green fair value zone. Now prices are in fair value. Prices on stocks are stay within the green fair value zone roughly 66% of the time, so 2/3 of the time. They move into the yellow overvalued roughly 16% of the time, and moderately undervalued roughly 16% of the time. Remember my example with the cars, okay? This is overvalued, this is undervalued. Now, if we get into an extreme, into the red significantly overvalued, or the red significantly undervalued down here, well, that's only in the red valuation zones 1 to 2.5% of the time combined. So this is really an extreme, okay? An extreme of down here and up here. So when we have extremes, there's always opportunity. So again, that's how we rate where the current price is in comparison with the real past prices over the analysis period. Okay, now this is the traditional open, high, low, close bar chart. So you're used to seeing this. This is price over time. Okay, very simple. As time passes, we get another bar, or if we get a specific number of transactions or ticks, we get another bar. So that's okay. That's how we've done it for 100 years. Next thing, so it's easy to understand. Now, when we have value charts, we plot the 5 primary valuation zones, just like I showed you in the previous slide. There's fair value, and then you have moderately over and undervalued, and then significantly over and undervalued. Okay, so as you can see, prices are moving up and down. Then the value of these prices move up and down in the value charts, 5 segments of value. You can see how it's moving. Now when you're trading, especially if you're trading at the open, it's hard to read both charts at exactly the same time. You're looking at 2 different areas. Sometimes plus below this, you may have MQ momentum that you're watching at the same time. So we actually combine that. We call this value bars. Okay, not only do we see the price and the time, but we can also see that prices in this area significantly overvalued. Prices in this area moderately overvalued. Prices in this area, fair value, down here, prices are in moderately undervalued, and prices down here, significantly undervalued. So easy to see, 2 sets of information on 1 chart. All right, the next and the last indicator that we're going to quick talk about is MQ momentum. Again, this is similar to MACD. I like this a little bit better. The algorithm works better for me in my trading. Basically, it's this. We have this fast line, and that is the indicator line, right? And then we have this dotted line. This is a slowed line. Now, when the fast line is below the slow line, that is bearish. And the histogram profile, which basically shows the distance between the fast and the slow line, is red, and it is below the 0 level. And when you see histogram profile like that, prices tend to fall. When the fast line crosses the slow line and moves above the slow line, we have histogram profile that's now green and positive. When prices are green and positive like this, prices have a tendency to rise. Okay, very simple, very similar to an MACD that you may have seen before. Again, what you're trying to gauge is the strength and direction of price movement, either bullish or bearish. Okay, so now that we understand the indicators we're going to use, how do we trade divergences? Okay, it's kind of different. When you think of divergence, you basically say you're comparing 2 items, in this case price and momentum. Okay, I'll just put MQ because that's our momentum indicator. If prices are going higher, what do you expect momentum to be doing? Going higher. If prices are going lower, you expect momentum to go lower. A divergence occurs when we have a price that moves equally high or higher and momentum actually goes down. Or we have a price that is going low or lower and MQ momentum starts to increase to the upside. Okay? That is what we call a divergence. It's easier to see on an actual chart. But again, divergences occur when you see actions in price and momentum that differ or diverge. A bullish divergence, a price, is basically when a price has made a recent low, bounced up, and is now making a lower low on the next pull down, but momentum is stronger than before. So price is likely to move up. That's why we call it a bullish divergence. The next is a bearish divergence. This is where price has made a recent high, drop lower, and now is making a higher high. Now the higher high and the lower low right here, they're a little subjective because it doesn't have to be perfect. This is in a perfect condition. But just for definition's sake, if the price is making a higher high, but the upside momentum is getting weaker, so the price is likely to move down. That's why we call it bearish. Okay. Now we use this particular phenomenon, this particular setup, bullish and bearish divergences, to create an intraday strategy that we trade every single day. Now, because we're trading intraday, these trades can last just minutes in duration, not necessarily hours. You'd have to trade a longer setup, but usually minutes, anywhere from 5 to 10 to 15, sometimes even to 30, but those are rare. Okay, usually in minutes. What we use, instead of, we could trade individual stocks and buy and sell shares, but we like to use options in the trading room, and we use specifically delta 70 or higher calls or puts. Really simple. If I think it's a bullish divergence and option and the price of the stock is going to go higher, I buy calls. If I see a bearish divergence and I believe the value of the stock will drop, I buy puts. Very simple. Okay, these are in the money, deep in the money options, delta 70. They're usually in the money by like two strikes, and they are less affected by time decay and Vega. But usually when we are trading intraday, the only factor that's important is delta, the price activity. Okay. Now, again, when we use deep in the money options, when we're correct, delta actually increases. This is a factor because of Vega. So when we are right, we are increasingly right when it goes our way. So we accelerate the way we earn money, depending on the strength of the move. So both factors work in our favor. Okay. Now, why are we using options? Again, leverage. Okay. You can control a whole lot more, a bigger position with options than you ever could with just individual stocks. Now, keep in mind, these intraday divergences, they don't move $30. They may move $3. But with the leverage, you can really magnify that $3 move. It makes a nice, very nice trades. Okay, which stocks do we trade? We can't pick any old stocks. We want to find high option and volume and liquidity. We want high option trading volume also. Okay, we want stocks with big stock prices because the increase in our option is dependent on the actual number of the price move. Oh my goodness, I'm almost, I can't even remember the real value. That's a mathematical writing. So a move of $1 in the underlying stock price will move the option 70 cents. A move of $10 in the underlying will move the price of the options $77. Okay, so it's the real value of the price movement. It's not a percentage of the stock. Okay, so that's why we want big stock prices. And we want these stocks to have large average true range, because we want the stock to have the ability to move within that average true range. Okay, the stocks that we normally trade: Apple and Google and Amazon. Occasionally we trade Tesla, Priceline, Netflix, and not so much CMG. But we're trading this a lot today. But Apple and Google, definitely. I'll show you what we did today so you can see. I'll actually show you the trades. Okay, so those are the stocks we trade, and we trade them with options, and we trade them well. Okay, let me just show you a couple of divergences so you can actually see what we're talking about. This is a bullish divergence. You see prices are coming down, and they make this low right here. That corresponds to this histogram profile. Do you see the strength of this downside move? Okay, prices bounce higher, and they come down here, and they make another low. Hit moderately undervalued. Now, when we look at the histogram profile of this move, do you see the only histogram bars we get to the downside is this one little red one? So if this is nearly equally low lows right here, from here to here, compare these two, the histogram profile is weakening. The downside momentum is weakening. So in the net result is the fact that the stock pops higher. This is where we buy our puts right here, and then we trade this higher. Okay, that is a bullish divergence. Everybody have bullish divergences down? I see a lot of people from the room, so you guys should be able to follow this pretty well. All right, next is a bearish divergence. We see this move higher right here. Corresponds to this move higher in the histogram profile. We have a little bit of downside momentum right here, and then we move higher. Actually made a higher high here. Upside momentum is much weaker. Indicator line is diverging. Now we do get a down pull to this moderately undervalued level where we could actually take profits, but it does pop up for a third time. And you can see this time too, momentum is even weaker than the second time and even weaker than the first time. So this is actually a divergent place you could buy puts because it's bearish, remember? So at this point, we have weaker upside momentum and the stock falls. Okay, we buy puts here and then we sell them down here. You sell them in a couple of different places, but that's where that's the result of this particular trade. Bearish, buy puts. Okay, here's one last one. This is an example in Google. This is from a little while back, but we had this upside potential move here, these histogram bars here, and then we have this strong move, significantly overvalued right here. Momentum is much weaker. We buy puts right here, and this is an example of Google being an expensive stock. When we buy the puts down here, and if we sell in this area and this area, if we sell in this first area, that's about a $7 move. If we sell down here, it's an additional $4. Okay, it's a delta 70 option. Then you multiply $7 times 70.70, so that's either 5, 2, and then $11 times 0.7, and just to keep it simple, we'll just say that is about $8. Now these options, the puts that I bought here, usually are about $15. Okay, buy it at 15 and I sell it here, that's going to be a $20 option. I made 33% on the money that I committed to this trade. So you sell it here, it's going to be worth 20. You sell it down here, it's going to be worth 23. Okay, that's why the size of the stock, the price of the price of the stock makes a difference, because you might have a similar trade in a $100 stock, but instead of falling anywhere from $7 to $11, you may have it fall like a $1, $1.50, $2. Okay, so what you really get is a magnification of the leverage when you are trading something that really moves. Okay, hopefully that's kind of clear. All right, let me show you some live examples. These are trades, that I took today. Just bear with me 1 second. I want to make sure I am on the correct chart here. Okay. I'm going to discard this for now. All right, can you guys see this okay? Good. There. This is Apple on a 250 tick bar chart. I have about 5 trades that we actually did in the room today. Now, those diagrams that I showed you, the examples, those are really pretty. What I'm showing you now is real life. Okay. Excuse the fact that I can't draw on these, but here's Apple. You see it's on a 250 tick bar chart. This is the standard size we normally trade. We actually come up here at about 9:40 in the morning, and we make a first high right against this resistance level at 548.50. Okay, so we come down, have downside momentum, and then prices come back up, hit moderately overvalued, and see how the prices are about equally high. Do you see right here where we have no upside momentum? There's no green histogram bars here. So we buy puts right in this area, and then the price continues to fall. It'll start to fall, and then when we get to this area, we sell some of our puts. Okay? Usually I sell as it's falling, and I reduce my position till when I get to about to where I think we may bounce, I'll sell some more. So we come down to this point here. That is roughly 48 1/3 down to 46 and let's say about 47. So so we fall about $1.40 right here. Then we bounce higher, back, retesting this resistance level again, and we buy more puts, and we fall again. Now this time it's a little stronger to the upside, so there's a couple of other things going on. I'm probably looking at a different tick chart, probably looking at a 250 tick bar chart, because we're coming against resistance, the same level that we were repulsed these times too. Then I'm actively looking for resistance here, and then for us to bounce back. Usually also the market is falling at this time, so that would encourage us to actually take this next trade. And we buy puts here. We sell some here because that's equal to this low from the last time, but we continue to power down and back down to here. This level right here is yesterday's high, and that's where we sell the rest. The MQ trend and one of our another indicators usually provide some support, so sell it here. So whereas this was a $1.40 move, we probably added about 60 more cents here, so this was a $2 move. It's really cool sometimes when you can basically walk the same path and pick up money the same way on the same path. So it's a really cool way to trade. So there's another divergence. This is a secondary, a double bearish divergence. Trades like this, you probably made anywhere from, this is a $1.50 move. Could have made about $90 a contract here, and the move here, this could easily be maybe $140 a contract right there. So that's the first set of trades. The next set is Apple on a 125 tick chart a little bit later in the morning. These trades occurred about 10 o'clock. You can see, another thing, the duration of the trades. Started watching this at about 9:40, and then we got out of the last trade right around 9:59. So this whole time period here is about 20 minutes. So we're watching again here. This is a 10 o'clock trade. Here's the first low. This is basically what this is right here, except this is on the 125 tick bar chart. I wanted to show you the divergence. Okay, here's the first move lower. You see these histogram line, the histogram profile. See the indicator line down here. Prices come down. They actually make a lower low, and we get is this one little red histogram bar. The indicator line is actually higher. So I remember this particular trade because the NASDAQ chart actually started bouncing at the same time. One thing we also do in the room is trade with the index, so that actually helps our divergences. So this is a bullish divergence by puts right here, and it runs up to this level, and I sell a couple of times. I basically sell right in here, and then it pulls back, and then it has what we call a momentum consolidation, and it runs higher. I sold half the position here, and the reason why I didn't sell more when we started to fall is because the NASDAQ was rising at the same time. So I held half the position and I sold the other half here when we hit these MQ trend dots. Now, the crazy thing is we bought them at 545 and a half, and then we sold half here. This is about $1.50 move here. This is another 50-cent move here. And what's crazy, we got out of the position. What did it do? It kept running. And we actually moved, it kept running and running and running till it found some resistance at 49.5. So if you held it, it's 45.5 to 49.5. This is a $4 move here. On a Delta 70 option, you probably earned about $3. And I remember these options, they were running about $9 a piece. So you earn $3 on a $9 option. It goes from 9 to 12, and that's basically a 33% gain on the amount that you commit to that. That's a $300 per option potential. Okay, I probably earned about half. I probably earned anywhere from $110 to $120 on that. Sometimes I leave them on to run, but I just wanted to show you really cool looking bullish divergence right there. The next trade we had that I want to show you is in Google. This occurred at, oh, by the way, we got in at, what's that, 10:01, and we got out by 10:06, and we actually hit the top about 10:09. So from here to the top is 8 minutes. 8. Okay, so that's a really good trade. The next trade was in Google. This one started at 10:13, and we basically had a frying pan bottom right here. Google was not breaking through these MQ trend dots. Actually corresponded nicely to these lows right here. Found some support. Okay, MQ trend dots here, whereas we were not breaking through. Thing about it was the market was starting to run higher. Now this occurred roughly 10:14, 10:13. We got into this trade also right after the other one, and the market probably pushed higher. Hold on. All right, that's right. I was wondering. Sometimes I get out of a trade and I'm doing another trade while this is running. But in this case, this is a form of, it's not a true bullish divergence, but is a trade we took in the room. Just wanted to show you when the market started to break higher, we jumped on it here, and then here we had higher highs. Bought right around 12:01, and then took some profits at 12:04, and the rest of the profits around 12:06. That is a $5 move in Google. These options run anywhere, they run about $15 a piece. So right there, that's a 30% move. And then I sold a third. I held another third in case we were going to run higher, because I learned my lesson from Apple. But nope, we started to fall, and I sold the other third here. Oh, actually maybe a fourth. 1, 2, 3. We pulled back down. I held this mainly because the NASDAQ was still going higher, and bought again here. Oh, okay. I know what I did. Okay, so I exited here, here, and here. So sometimes what you get when you trade like this, you look at this high, and then you look at this next high. You see you had a bottom, it moved higher, you made a high, you pull back, you make another high. What do you have here? This is a bearish divergence. So I actually bought puts here, and then I got stopped out about half of them here, and then this became a really messy trade. I held it because I was waiting for a rollover in Google, and then when we got to the top here, saw a bearish divergence on a shorter term time frame, bought some more puts here, and then eventually it dropped to these MQ trend dots. Okay, that was I wouldn't say that was a good trade, but that was a decent trade. The opportunity was there, so we took it. That trade lasted a little bit longer. That's 1039. We got in that one 1022. So that's about a 15-minute trade. This trade from here to here, 1013 up to here, 1018. This is a 5-minute trade. 5 minutes. Okay. So that was really good. The next one, I showed you the fourth trade. This one right here. And that's at 1035, yep. And then the last one is Apple again on the 125 tick. This was on the, is it 1050? All right here. All right, so we have Apple finding some support here, came down, made a low. See the histogram profile? Okay, this is not a divergence because of the fact that the histogram and indicator lines are about the same. So when it came back down a second time, you see how the histogram profile is much weaker to the downside. So you compare these lows right here, these 3 bars, with this low right here, and the market started to shoot up. So this is a smaller trade, really wasn't looking for one, but I just took it. So it went from 549 and a quarter up to here, 549, 550. So really just a 75-cent move. But the crazy thing is a 75-cent move with a Delta 70 option. If it's just one quick scalp trade, that's $50 a contract. Okay, 50. So it makes a difference. Usually I trade so it makes a difference. Ken, you're asking for some of the ones that are messy and I make a mistake. Well, Google was a good example of one here. When it broke against me, I reduced my position in half as it was running higher. Now, based on, I was looking for a place to repurchase. Whenever we have a stock that continues to break and make higher highs, I watch it to see if we start to weaken this momentum. Now, I'm pretty sure I got out of half, if not all, because of my particular stop. But these here are times where I'm trying to get back in here and here and here. The one thing that I'm watching, especially with Google, is the momentum picture. Okay? It's very important. While we're getting these higher highs here, from this point here to this point over here, look at the momentum picture. Do you see that? All the histogram bars are down. So we don't have any green momentum. So I'm waiting for a break here. And eventually we get one right here and the indicator line breaks lower. Now I'll be the first to say this isn't the best setup. And right here we probably made enough money just to break even, if not a little bit of profits from this move from 1209 back down to here to 1270 and a half, 1207 and a half. Okay, but that right there, it's I can't give you a very, very firm rule. The firm rule that I can give you is this. See this, looking at this as a divergence, and it doesn't really fall. So you have a stop, you have a mental stop, get out. Okay, until you get more experience trading this. That's why instead of just blanket getting out, I'll sell half a position, I'll sell 2/3 of a position, and then I will hold the rest and look for a place to get back in this. Okay, and then sometimes if this beats me up 2 times, I just will leave it alone and say I'm not trading Google today. I'll trade something else, or I'll just give it some time and then maybe it'll start behaving normal, because this is not normal behavior. When you have downside momentum and the stock does not fall, it's a sign of a very strong stock. So you have to be careful when you're kind of trying to work the trade out. How do I use MQ regression? The one thing with MQ regression that I watch, and I'd probably say it's towards the bottom of all the indicators that I'm watching, the color of the trend is green, so it's bullish. I don't really care about that. What I care about is the strength of the slope, okay? Because one thing you notice here when we start to go flat, do you see the slope down here? It's about 30 degrees. Look at the slope here. It's about 15 degrees. It goes flat here, and then it pulls down. When we start getting flat like this, and sometimes you catch a divergence, there's a good chance you might want to hold on to that, because when it goes flat is when it's about to turn and change direction, and that's what you have here. But you always have to understand MQ regression runs at a lagging position, so sometimes you could have the stock starting to fall and this is still reading green. So I really don't follow trend following. I read and watch momentum. And if we get into a position where we start to go flat, that may be the opportunity to try to get short. Or that usually when we have strong moves, you'll get a divergence before a change in trend. You'll almost always do that. You very rarely get a stock that moves straight up and straight down. You have too much upside momentum to bleed off before you can reverse. Okay, that's why I always, when we start to go flat like this, I watch for momentum, for divergences in the opposite direction. So hopefully that answers your question. And I'll tell you also, Ken, your question, we don't normally have a lot of misses. I said that playing divergences in the first hour and a half, 2 hours, we have a pretty good track record. We do take some losses as we go, but that almost always gives you an opportunity to get back in and make some money that way. Okay, any more questions on the live charts? To answer Joe's question, how did we do today? Now, please keep in mind, this is trading about 30 contracts, okay? 30. So I want you to look at Apple and I want you to look at Google. For Apple, we made about 6,000. Google, we made about 3,600. Together, that's almost 10,000, because I actually traded in another account. Actually, it's a little bit more. This particular trade in Priceline, I'm just holding on to it. I think there's a lot of potential there. But right there, here, and here, we have no outstanding quantities here. So roughly per contract, and that's what I always try to boil it down to for the people in the room. When I tie in all my trades today, roughly about $400 a contract. So if your account can handle one contract at a time, and you took all the trades that I did and traded just like I did, that's what you could say, that's how you can equate it. If you're trading 5 contracts, then you multiply, 330 by 5. Okay. Yeah, you can trade them. You can trade them one contract. I trade my other accounts usually 3 and 5s. 3 and 5s is what I usually trade. I like trading more than one contract because it gives me some flexibility on the exit. I can trade one at the yellow undervalued and then trade the other one when I think it's time to get out. Okay? Any more questions? Joe, I just use Toss's normal order entry system. Sometimes I give a little bit on the mid price. Okay? Any more questions? No, sure. Today, Toss gave us some trouble. But basically what I was doing with Priceline, Sue was asking me about that Priceline trade. I was watching on a 1 minute, actually, I wouldn't say it was a divergence, but I was looking at this triangle pattern here near the high, very close to after we closed the room. And I played puts falling from moderately overvalued to moderately undervalued. I do that 2 or 3 times. Was holding the position, about to take profits, and all of a sudden we dropped. And when we drop like this, I actually moved those excuse me, I moved those 20 puts to break even. Why am I trading puts in Priceline when it's doing this? I'm actually fishing. I'm fishing for a top. I was going to take some profits off the table, but actually I'm more interested in holding them and seeing what we do in Priceline tomorrow. Because we've had 1, 2, 3, 4, 5, 6, 7, 8, I think 8 or 9 days straight up, and Priceline has a tendency to turn. It's falling, it turns, and it runs. Okay, and right now, if we even get a 1/3 pullback, this thing could move easily $40 or $50 in one direction. With the very little time that I enter, how do I deal with the spreads? See, a lot of people worry about spreads. I try to get in at the mid price, and I try to give a nickel or sometimes a dime if it's Google. I don't worry about it. If I get filled, I get filled. If I don't get filled, then I just miss the trade. Because you can see in the first hour and a half, I had 5 trades today. Okay? And if I don't get filled and it moves away from me, then I just miss the trade. But it's not like I won't get one in the next couple of minutes. What's important is using limits to get filled properly and not expose myself to too much risk. And there are times when you'll watch it and the divergence hangs, okay? Because basically what you're doing is prices are moving higher, then they move lower, and they're moving higher again. Now, there is a period of time right in here when it runs out of upside momentum, and then it pauses for a couple of seconds, and then it starts to break. Okay, now this is not the best example because this continues to run, but some of our Google, Apple ones and stuff like that. Another thing too, you must, if you're worried about bid asks too much, it's because you don't trade these particular stocks. There is enough volume in Apple and Google that as long as you put the order out there and this thing is bouncing up and down just a little bit, well, because this is an expensive stock, it's bouncing up and down, you have a reasonably priced midpoint, you have a reasonably good chance to get filled, especially if you give a nickel, mainly because it's bouncing around. You're not going to say that, oh, this is the firm line, 549.24, and that's where we're going to get filled. No, it bounces up and down a quarter, up and down a quarter. I may not get filled in this bar, and I may not get filled in this bar, or I might get filled in this bar because I leave the limit order out there, and then it runs higher. So you have this is 55, this is 56.5, this is 57. So you have 2 or 3 minutes to get in here, and it's liquid enough that you can trade it. Now, if you don't want to use options, you can use individual stocks, but with these, you're going to have to trade something else. The concept is the same. It's just that you need something that moves. Remember our criteria for the stocks. It's a large price stock. It has a large average true range that is active in price, and then it actually can make these intraday moves. If you get something that's very illiquid, basically it's going to move higher and it's going to stay there, and it may round over and fall down. That's all it's going to do the whole day. So there's no tradable pattern. So you want something that you can trade. Okay. Cam, if you come to the trading room, you'll be able to see. Yes, you have to be quick. But it's basically like if I'm trading Apple and I'm trading Google, because maybe Amazon is not behaving, I have 4 options. I'm either trading Apple calls, Apple puts, Google calls, Google puts, and they're delta 70. So those things don't. You can see my what I traded today in Apple. I traded these calls and these puts. That's it. Don't worry about that one. That was residual from Friday. But this one and this one. And then this one in Google, I traded these calls and these puts. I had 4 different options that I traded today because I played them from both directions. Why do I use different tick charts? Because the volume in these particular stocks are different. Okay? Apple trades, I like the bar formation to be about 1 bar every 30, 40 seconds. Okay? I don't time it, but that's the feel I get. Sometimes they're closer to 1 every minute, but that's okay. When they're being actively traded, I get 1 bar every 30 seconds. All right? Google is the same thing. Actually, it's a little bit slower. Amazon, I trade on a 75 tick. Okay, this is what I call my primary trading charts. Here, Google 75 ticks. Amazon 75 ticks. And then I also bring in these charts. If I'm trading Apple and I'm about to enter a position, I'll also utilize this stock chart. Okay, this is a 125. I call this my half-size tick chart because I'll get 2 bars for every 1 bar here. And usually when I start to see a divergence like this, I want to see it to start to fall. Well, usually it's going to start to fall here on the half size first because I get twice as many bars. I can see the fall. And then I can also read momentum in both charts. Okay? Why delta 70? Because I want to optimize the amount of gain I get for the particular move. Now, I also want to balance that with using a large amount of leverage. I could step in here with a delta 90 option, but the problem with that is whereas I'm trading $8, $9 options on delta 70, a delta 90 probably run me about $24, $25. And I can, whereas I make 70 cents on a $9 option, I can make 90 cents on a $25 option. Do you see the leverage picture there? So it's a balance between leverage and getting a good return for the underlying price movement. Okay. Another thing too is the fact the liquidity. Because it's closer to the stock price, it's delta 50s right in the middle when the price is right there with the current strike. Those are delta 50s. Those are the most liquid. The further you get away, the less liquid they are. So if you're trying to trade delta 90s, delta 80s, you don't want to do that. Another thing too, let me just squash this particular bug. You cannot trade this strategy with a delta 20 option. Please don't try. Okay, I don't care if you can buy a 50-cent option, because if this thing falls like this, you'll be lucky to be able to sell it, let alone make 5 cents on it. Okay, stick with the ones. I'd much rather trade 1 delta 70 option than 10 delta 20 options. You're just not, it's going to cost you more in commission. You're not going to get the return. You don't get profits based on the underlying price. That's a losing game. All right. Yeah. The problem is, Kiernan, please take before you trade options, please take one of my Fundamental of Options courses. But the point is, it's the delta. You look at the really cheap options and the price moves $2 the direction you think it's going to go. You're going to sit and wonder why your delta 20 option is not changing. It's because the delta reflects the changes of the option in relation to the changes in the price of the underlying. You really need to get that. If you move $50 in the underlying, then your delta 20 option will, quadruple or quintuple. You can make a ton of money that way. But when we're trading intraday, we're trying to put money in our pocket. So this is a way to do it. All right. I'm not going to worry about a delta 20 option if I can trade this and put $100 a contract. If I'm trading 30 contracts, that's a $3,000 move. Okay. No problem. Support and resistance lines on my tick charts. You guys know it. Basically what I try to do is plot daily support. I plot highs and lows. I also plot pivot points off of the daily chart and I put them onto the intraday chart. Why? Because the yellow line here and this yellow line here, this is Friday's high, and this is the high of the day, and this is Thursday's high of the day. Why? Because they naturally provide good support and resistance levels. Okay, and these green lines, these are pivot points based on daily numbers. Down here, let's see if I have it here. Down here I have this is Friday's low. This is Thursday's low. I place them on there so they give us nice support and resistance levels. I like to trade divergences when they are approaching support and resistance levels. I really do, because you can see here. Look at this move. Prices come down. They come straight down, hit Friday's high because we were trading above it, and it just bounces. You know, support and resistance is very important because this is an intraday chart, but this is a daily high. Every once in a while, Ken. Yeah, I do use voodoo lines every once in a while. I don't plot them on here. I just keep them in mind. You can see here, here's price lines, voodoo lines, and I watch them as they approach. Occasionally I'll have them on here. I can't have too many lines. You can see, I like to trade cleanly. That's why I don't have 20 different indicators on here. I have an 8-period EMA, 21-period EMA, and MQ momentum, and the squeeze indicator. Squeeze indicator, I don't use the squeeze function. I just use the histogram bars. If the histogram bars are going lower or down here going red and they're going lower, that's bearish. I want to trade in that direction. If the histogram bars are going higher, see they're red and they turn dark red here and they're going higher, 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 higher. That's the direction I want to trade in. Okay, and that's the same thing I do for the Nasdaq. I'm sorry, you can't really tell because this is the futures, but I watch the Nasdaq on a 30-second chart, see which way it's moving. If it's breaking in a particular direction, that's the direction I want to trade in. I don't really want to go against the market. Again, everything lends to the fact that I want to have high quality, high probability trades. I don't want to take a flyer and say, hey, this could do this. I like, well, when I'm trading Apple and I want it to go higher, I want the momentum higher on this chart. I want momentum higher on this chart. I want the squeeze higher on this chart, squeeze higher on this chart. And then on the 30-second NASDAQ chart, I want momentum going higher, price going higher, squeeze going higher. And at that point, I'll step in here and I'll buy calls. Okay? It's very simple. If everything is going in one direction and I'm playing a divergence that is bullish, then I have a very high probability to be right. If I'm saying, well, half the things are saying one thing and half the things are saying another, and I want to go in this direction up, but the market is falling, I'm not going to take that trade. Because sometimes people, they don't see a trade for a long time and they want to just jump on the first one that comes along. I don't have that fear because I have 5 to choose from just in the first hour and a half. Okay, I have 5 to choose from. If I don't like the trade, I stand aside. I preserve my capital. I could be right, and there's some times where I'm like, oh, I wish I could have taken that trade. It kept going, or it really did reverse. I don't know if it was. It didn't look good to me at the time, so I won't take the trade. Okay. No, all these, actually these are voodoo lines here. I do have them on this tick chart, but you see how they don't really come into play until we actually hit one. A little resist line here, a little line here. The next voodoo line is up here. I actually don't see one. So I mean, again, because it's an expensive stock, the voodoo lines usually we run into them every once in a while. Actually, I don't know why I don't see it on this tick chart. No, but these are voodoo lines right here and here. But again, more so, I mean, I watch for the pattern. The support and resistance lines are very important, especially when they represent yesterday's high or yesterday's low. And I adjust these positions every morning. I look back 2 days. That's usually enough. See if we have any more questions. Do I trade the E-mini? No, I do not. I do not trade the NASDAQ, QQQs. I do not trade the E-minis. You can use the same methodology to trade futures. I just like it because I like to trade individual stocks. I like to trade at the open. That's when it's all volatile. Sometimes when I trade futures, it's like, well, there's some volatile periods and there's some quiet periods, and I can't figure out which one's which. Thomas is really good at that. But we use the same methodology when we trade our divergences. But I've just grown accustomed to trade these. The one thing about trading the QQQs or the SPYs, and I did that last time on when we trade the FOMC announcements. The crazy thing is, these things are so cheap. These options are running anywhere from $1 to $2, and in order for me to commit enough money to the trade, I have to trade 5 or 6 times the number of option contracts. And the thing about that is Thinkorswim doesn't care if you're trading the Qs or Apple. They're still going to charge you the same amount commission per contract. So it becomes a little bit cost prohibitive commission-wise to trade a $2 option. That's why I like to trade a $10 to $12 option, sometimes in Google, 15, 16. I can trade something a little smaller, but I also find out that on Thursdays, Fridays, when options get a little cheaper, I just trade more number of contracts, and I actually make more money on those days. That's just me. Where do I put my stop, Bahani? You're going to have to watch how I do that, because divergences can be subjective, okay? Remember, let me just see if I see one. Let's just say this is a divergence here, okay? Let's just say, I'm not going to look at this, but I'm just saying, okay, prices make this high right against this resistance level. They come down, they come back up, and they're right here. Don't look at what these bars did. Say we're right here in time, okay? Now, will prices diverge from this point and go lower? Because just say the momentum picture does look like that. So that would be a good trade. Boy, if we keep going higher, we make an equally high high. Is that still a divergence? Yes, as long as the momentum picture still looks good. And that's diverging. Okay, so equally high high. That's still a divergence. If we go higher here, if it spikes higher, makes a significantly overvalued level, as long as the momentum doesn't overpower the histogram profile back here, the divergence is still good. So you can't say that I have a firm stop here, because you have to read and watch momentum. You have to read and watch what the market's doing. Sometimes you get a divergence that looks like this, and then it rolls over. If you just say, I have a hard stop right here, and you get out, and you're not paying attention to the fact that the momentum is actually dropping, and maybe the NASDAQ is starting to stall, and it's doing exactly like this, but you can see the momentum picture is really starting to get weaker in the overall market, then you'll get out right before it starts to fall. Okay, you have to have, because you're trading kind of against the grain, basically, of the way the prices of the underlying is moving, you have to have a little bit of confidence in your ability to read momentum. Okay, read what the market's doing. That's why I use 2 different time frames. I use both sets of indicators, and I trade with the NASDAQ. It gives me more feedback and confidence in taking the particular trade. So yes, mental stops. You have to be kind of tight with them. Do I hold trades overnight? No. This particular setup that I showed you today occurs within the first hour and a half to 2 hours in the day. Period. You can trade divergences just like I showed you, but on higher time frames. Your stop loss is much higher, and you have to hold it overnight. I do not trade positions that are having earnings. the one position that I have right now in Priceline kind of goes against that grain. I just really wanted to trade this. This reports earnings on Thursday. I'll be out of this sometime tomorrow. Or maybe if it keeps going my way, I'll hold it through Thursday morning, Thursday lunchtime, and get out before earnings at the end of the day. I just won't hold it. Any more questions? I will hold it during FOMC. I like to trade FOMC announcements too. The last time I did it, I showed people, because people were saying, when you trade FOMC, can we trade something other than one of these stocks? The main thing is when you have a news announcement that pushes the markets higher or lower, Dow, S&P, and NASDAQ all basically trade the same. So that's why I like to trade the NASDAQ, and I like to trade one of these underlyings. Now, when I traded this the last time, someone said, okay, can you trade it in the Qs? And I said, okay, I will show you why I don't do it. Because we had a nice move. I don't think it was FOMC, it was something. And I traded the NASDAQ QQQs. I think they were trading for $2 or $3. I traded 300 contracts of those things. 300. I played a little divergence on the move and it bounced. So I made $14,000. The commission cost for that set of 14 the trades, I think there were 2 trades, on the $14,000, $4,500 of it was commission. Commission. It ate up a third of my trade. Now the thing about the if I had traded it with Apple or Google, I probably would have had commission cost of just roughly maybe $1,000, something like that, $1,500 at the most, roughly 10%. Okay, so commissions make a big difference. Make a big difference. Okay, any more questions? If you are a platinum member to the options trading room, you will get invited to watch trade FOMC tomorrow. Now, with that said, this is what I would like to show you guys. There is no reason for you not to be a member of the live trading room. Let me put this up here. Right now, okay, that's a bearish divergence. I'm sorry, I'm trying to find the slide that I'm talking about. So right now, just in summary, trading momentum divergences with options can provide you several opportunities every day to consistently make money on a daily basis. Okay, weekly options on actively traded expensive stocks provide a great deal of leverage. Okay, leverage to trade these opportunities. This is a trading strategy. If you live on the West Coast, trade an hour per day, make 1 or 2 trades, make money every single day. Okay, make money every single day. It's compounding every single day. That's a good way to trade. If you want to learn the strategy and become good at it, I've showed you the basics of it. Now you need the experience in seeing the trades live. Okay, try to get into the options live trading room. And right now we have a great opportunity with the current special. You can try the platinum membership. Now the platinum membership allows you access to both trading rooms, the futures and the stocks and options one. You get to watch me and Thomas, both great opportunities. And right now we have a special for the first month, $7. $7. The price of 2 Starbucks coffees. Okay, depending on what you get, maybe it's even cheaper. 2. That gives you access for 30 days. After that, it's $97 a month. Okay, go to valuecharts.com/go. Okay, for anything, right? I mean, really, is it worth your time? $7 to watch us trade this over, a couple of days. You can learn something. You can see it applied in real life. I always tell people in my live trading room, get the knowledge, attend workshops, learn about new trades, and then apply them. You need experience. Both are the same. You can be book smart, you can read, you can study, but if you never put a trade in, you'll never gain the experience. And eventually experience becomes more important than learning new stuff. I say that, but if you were to basically say learn one trade, then that would be this would be the one. The one thing I also want to tell you guys, in case you haven't seen it, if you like divergences and these types of trades that we're doing, I'm going to be attending this workshop that Thomas will be holding, and this is tomorrow night. Oops. Please keep this in mind. This is his high probability continuation and reversal patterns workshop. I've been waiting for this, because not only will he talk about divergences, but we will also be talking about momentum plays that that kind of go hand in hand. If one is the right hand with your divergences, your left hand are the momentum plays. Because there are times when we'll do a divergence, it won't work out, and the thing will just run. And that's when you want to try to jump in those, because a divergence is extremely strong type of setup. Okay? Because logically it makes complete sense. If the divergence breaks and it starts to run in the direction you thought it was the opposite, that's something fundamentally changing in the stock. That's a good one to jump on and run with it. Okay? So right there, that's a great opportunity. Normally, Thomas's workshops, the 2-day ones, run about $500. Usually you can get in at a discount like at $399. This one he's holding, it's just one night, but this is new material. Normally it's $300. We're pricing at $97 right now. A really good opportunity. Just want you to make you aware of it tomorrow from 6 until 9. Okay, I'm going to be sitting in the front row because I want to absorb all this information. I learned a lot of my stuff from Thomas, and he's a great guy, great teacher, great instructor. If you can't make it, that's fine. Attend it anyway, and then watch the videos. Because those will be available really soon after the fact. And if you have any questions, you can always email him directly, and he'll get into a conversation with you. Make sure you understand it. Okay? You really, 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 really need this stuff. I don't advocate stuff that's not worth it. And I'll tell you, not most, but I can't think of the last thing that I would say that, maybe you shouldn't take it. Microquant puts out good stuff. We don't rehash things. All this stuff, all this stuff is new. Half of this stuff I haven't seen before. All right, so just want to let you know, remember that $7 offer. Please, you're not going to get anything better than that. $7 for 30 days. And then you'll get billed following that for $97 a month, which is about $100 off. Eventually, we're still progressing with our platinum membership program. Eventually, it'll be pushed up to $197 because you are getting 2 trading rooms and a lot of signal feeds. We have special things that we do. If you're in the live trading room, you know that Tuesday afternoons we usually meet to put our weekly spreads on. Tomorrow we have FOMC at 2 o'clock. We'll come back into the room to do that because our normal trading times are 9 a.m. to 1 p.m. in the afternoon, but we'll come back at 2 tomorrow and then see how it goes there. So anyway, so does anybody have any more questions? I just want to show you these opportunities. They're great chances to get into our great programs. Okay. All right. Well, if there are no questions, I've held you about 17 minutes past. Please, these things that I'm showing you, we refer to them as golden shovels. It's not something that I just throw up here and just say, hey, this is an idea. I trade these things every day for the past 10 months, and I do very well with them. Thomas does the same sort of thing. So this is not fluff. This is how we earn our money every day. Okay? Thomas and I, we trade real money in the rooms. Me, I have multiple different accounts. Sometimes I trade simulated, sometimes I trade real. Thomas, same thing. I think his is all real, to be honest. but we don't have time to trade fluffy trades. We try to make money every day, and that's our that's our focus. To mimic these trades, Mark, you really need value charts and our value charts bundle. Now, right now, the value charts bundle runs $14.97. Here's my advice. Don't buy the bundle until you become a member. Become a member, you get a discount on the bundle. Okay? And that basically will pay for almost 3 months of the platinum membership after the first 7. Okay? So my advice is come into the room, watch us trade. Watch how we use these indicators and then make a decision. Stay in the room some more. And if you really like the way we trade, then and you want to learn to do it yourself, then buy the bundle. I bought the bundle before I worked here. I was a trader in Thomas's futures room, and then I mentioned to him about my interest in applying the same stuff he was doing to stocks and options, and then he said, "Wow, how about we talk about it?" And 2 weeks later, I started working for value charts, and I've been here since first part of March. So I'm up to a year. But yeah, that's my suggestion. Go in for the $7. Watch us trade. You like what we're doing, can follow what we're doing, then just keep this running, and then step in here, buy the ultimate bundle because it has value charts and MQ momentum. You don't have to get it. It's just if you like your own momentum indicator, then you can trade this. But we use the MQ momentum indicator suite, and then buy it at a discount. Learn to trade, attend a couple of workshops, and you're good to go. I do trade longer than 1 day, Mark. You have to come to the room because we also trade weekly spreads. These are the weekly spreads that we have right now. We actually put them on at 3 o'clock, 3:30 today. We have some bearish put credit spreads here. And then we have bullish put credit spreads in LinkedIn. Here, bearish call credit spreads here and here also in Amazon, CMG, and Apple. Okay, this is kind of out of the realm of what we're talking about right now. I do not want to see these because we don't have losses. Okay, so I mean here's just one quick peek. This is what we did last week. Actually, most of the traders let these expire worthless. They made 4.76%. They made about $1,200 on this position. And we committed about $25,000 to this trade just based on what you see here, and that comes out to 4.76%. I traded some of these intraday, similarly to what the trades I showed you. I added on another 1,300, 1,100, and 4,300 in the positions, but that's not counted here. But anyway, we do have other kind of trades too. Do I trade mostly credit spreads or directional? I trade both. In a week, I may trade 25, anywhere from 20 to 25 intraday trades, and then I have these weekly spreads. We're slowly adding more, but directionally we trade about 20 to 25, and then sometimes more, and then on the weekly spreads we trade maybe 4 to 6. So come to the room, Mark. Spend $7, sign up for it, come to the room, and I think you'll be pleased if you like the type of trading we're doing. Okay. Oop, that's an old one. Sorry, it's not 97. Any additional questions? I'm about to want to make sure everybody's questions are answered. Vince, I would be a little careful in terms of trying to get those particular spreads. It depends on how those stocks open. If they move in the direction against us, then the credit you'll receive is going to be more than this. if they move in the direction we think they're going to move, then you probably won't get these credits. Okay, you want to be careful if you try to adjust too closely. Okay, right now it looks like we're going to pull back. That's actually good for these 3 positions. So we'll continue to watch and see how that goes tomorrow. Yeah, it's hard to give advice on that, especially at the open, because there are times when it's advantageous to jump in right at the open. Sometimes it's good to give it a good 10 minutes and let it settle out, because we might have a spike to the upside, a spike to the downside, and then that'll give you an opportunity. And then when it the spike comes back towards the middle, then you may get a chance to get filled and not have to chase it. All right, any more questions? All right, well, thank you again for attending tonight. If anybody has any additional questions about our live trading rooms, feel free to contact me. My email is dave@microquant.com, and be happy to assist you. Vince, I understand that concept too. I like that, especially when you're trying to get filled on the spreads. So please, this is a great opportunity. I wish this was around when I first found the trading rooms. It's okay. I don't begrudge paying for it because I learned a lot. Okay? So come to the room and get the other half of what you need. You have the knowledge. Now you just need the experience. So it's nice to see everybody. And everybody have a good evening. It's about 9:55, so we'll go ahead and close it for tonight. Let me know if there's anything I can do to help. Have a great night. Thanks for attending. Mr. Lin, yes, this recording, I'll process it as soon as we get out of here. And we'll have it loaded up into YouTube. Hopefully have it up in the next day or so. All right, everybody. Have a great evening. Thank you. Good night.